Okay, through the power of social media, looks like we're broadcasting live again. Good morning, Declan.
Good morning. Happy 21 to you. 21. Happy 2021 to you, Patrick. I know you're more than
2021. Yeah,
21.
it's difficult getting here. I know. So after a little hiatus over the holidays, we're back at it again here with a Wicked Awesome Report. I'm your host, Patrick Quayle, and your friend in the mortgage business, joined by my friend in the real estate business, Declan O'Toole from Select Real Estate. Back at it here for, this is the first broadcast of 2021, and we're going to be talking about affordability and housing affordability. Unfortunately, the mass media is out there and is talking about home prices increasing, and the homes are less affordable because of that. So don't believe all the mass media hype about a housing bubble or a pending housing crash, or homes just being out of control, no longer affordable. It's not accurate, not true, and we're going to show you why. So you ready to dig into that?
I am indeed. Thanks,
Okay.
Patrick.
So I think I'm going to do this correctly here and do a screen share. And okay, so hopefully that is broadcasting correctly, and we've got the affordability myth shown here. Give it a second for Facebook to catch up. A little bit of a lag time here. So we're going to get rid of all of the misinformation and misconceptions with homes no longer being affordable. So, all right. So it looks like we are broadcasting the correct screen here. Fantastic.
Patrick,
So,
just before you get into it, as people are catching up, what is affordability? What's the talking about? As soon as we're talking about housing affordability, first off, right?
Exactly. Yeah. So housing affordability. So basically a comparison of what that purchase price and really more what the monthly payment is compared to what income is. So again, we're seeing some appreciation and some prices increase. The mass media is portraying that as being homes are less affordable, it's out of control, scaring the poor first-time home buyers that are trying to get into the market, and sort of making them think that this is impossible. They'll never be able to achieve home ownership.
So basically your housing costs, which would be your rents, rates, and mortgage, of course, if you're a homeowner, to what your gross income would be.
Yep. So exactly. So even though we have seen increases in values and sales prices, we're still in one of the most affordable markets in history. Okay, so let's cover that and start from the beginning. So just for reference, this chart that we're looking at right now is an affordability index. Okay, so 100 is sort of the break-even point. So over 100, it is a more affordable market. Under 100 is a less affordable market. So this chart is running from 1990 to the end of 2020. So we'll discuss what it actually means, what goes into making up the affordability matrix. Okay, so an increase in home prices doesn't necessarily mean that they're less affordable. Okay, now that sounds like a contradiction in terms. Of course, the purchase price is a contributing factor, but it's not the only one. We have to look at the right metrics. And unfortunately, the mass media doesn't really do a good job in explaining what the right metrics are. The mass media, bad news, scare tactics, that's what sells newspapers. That's what gets eyeballs. Yeah, the headlines. That's what get eyeballs to watch those news broadcasts. The good news like this doesn't always get top billing. So let's interpret the data and accurately describe to the public what it means. Okay, so just before we started going live, Declan, we were talking about average home prices and median home prices. Okay, and unfortunately the mass media uses those terms interchangeably, and it's just not correct. The average home price and the median home price are two different things. See, the median home price means that half of the homes sold are above that median home price, and half of the homes sold are below that median home price. The median is the number that's in the middle. And again, the mass media sort of uses those terms interchangeably, but again, the median is not the average. And I know math is hard. I struggled in my statistics classes in college too. Okay, now when we talk about sales prices, really the median home price is, again, one of the statistics that we need to look at. Half of the homes sold above that price, half of the homes sold below that price.
So
Now,
December 2020, so 2020, the Greater Boston Real Estate Association, they basically said that I believe the median home price was 700,000, and there's like 64 communities in the Boston area. So you're saying that half the homes would have been under 700 and half the homes would be over 700. So you could have quite a few in the fours, but you're going to have quite a few that are
exactly.
1.1 and above.
Exactly. So the average is going to be skewed. You're not going to end up, so the median and the average are not going to be the same. And unfortunately, again, the mass media just uses those terms interchangeably. I don't think too many of them spent as much time in statistic classes as I did. So, so the stats do show us that recently the median home price has increased by over 15%. Okay, now that doesn't necessarily mean that home prices across the board have increased by 15%. Again, the median is the number in the middle. Really, what that is showing us is there's a lack of inventory out there. There is a lack of available inventory specifically for first-time home buyers. And you think of first-time home buyers, that's typically a lower purchase price. That's the entry into the market. So if there are less of those lower priced homes being sold, well, then that median number is just going to move higher because you've got more of the higher priced homes sold. So that median number moves up. So that's part of the reason why we've seen an increase in the median home price of 15%, just because there are fewer transactions on the lower end of that purchase price range. Now, we have seen an increase in purchase price specifically of about 7%. So I'm not necessarily talking just about the Metro Boston market or Massachusetts. This is coast to coast. So these are national numbers we're working with. Okay, so if we have seen a price increase of 7%, that's still a big number. Okay. And again, that's another reason why the mass media is saying, well, prices are up. It's tough for people to buy. Prices are going up. How can someone afford to purchase a home with a 7% increase in prices, or with the median going up by 15%? It's so it's still a big number going up by 7%, but to a certain degree, that can be kept up with. That 7% increase can be kept up with by increases in income. And it doesn't need to be a 7% increase in income. And I'll show you some of the statistics and exactly how those numbers work. Okay. But when we talk about income, again, we got to take a step back and talk about the right metrics. The mass media is not necessarily portraying the picture with all of the correct details. So most media outlets are going to talk about hourly earnings, how much money you earn per hour. Okay. Yes, that's a measure, but it's not the correct measure. We prefer to take a look at weekly earnings. Okay. So you could be, working and earning, $20 an hour. Great. You get a raise to $25 an hour. That's great. You got an increase.
Yes.
But what if they cut your number of hours worked from, from 40, you're cut down to 20 or 25? Sure, you're earning more per hour, but you're working less hours. Okay. So it doesn't really give a good depiction of how much money you're actually earning. So we prefer to take a look at weekly earnings, which combines, the number of hours you're working and the hourly rate that you're earning at. So it's a more accurate depiction of what that take home, that take home pay for that consumer is. Okay, so the better metric is always going to be weekly earnings. It's just a better number to show how much that consumer is actually taking home. Okay, to be able to pay their bills. So year over year, that has increased by almost 6%, 5.9%. The weekly earnings has increased by. Okay, so the naysayers are going to say, okay, well, great, weekly earnings has increased by 5.9%, but we've still seen an increase in prices of 7%. Hourly, weekly earnings are not keeping up with what those sales prices are, and again, we're not necessarily taking a look at the right metrics or analyzing the numbers correctly, because you don't need every single penny that you're earning to pay what your housing expense is. Okay, so let's dig into some of that. So we'll give you a sort of a real life example here. So let's say a year ago, okay, so going back in time here, let's say a year ago, you had a mortgage payment that was $1,000 a month, okay, and actually these statistics are not something that I made up. These are figures that are coming from Fannie Mae and Freddie Mac. So this is the, we've rounded everything off just to make the math easy. But let's say that you had a mortgage payment of about $1,000 a month. Well, you would need about $5,000 a month in income to qualify for that. Okay. Now, again, your income is not all going towards the housing expense. You've got student loans, car loans, other expenses. So in average, for someone to qualify for a home and with all the other liabilities that they have, they need to have about $5,000 a month to carry $1,000 a month mortgage payment. Makes sense so far? Okay, great. Now, if we have seen, let's say, a 5% increase in price, so prices have gone up, which means you'd have to borrow more money. Okay, so if your mortgage payment goes up by 5%, in order to, so we're going from 1,000 to 1,050 a month. Well, your income doesn't have to go up by as much. You only need to go up to cover that extra $50. Your income only needs to increase by 1% to cover that 5% increase in price.
1/5 of the difference.
Exactly. So when we talk about weekly earnings not keeping pace with appreciation, not keeping pace with the increase in prices, the earnings don't need to increase at the same rate that that the prices are. Okay, because again, you're not giving all of your dollars earned going directly into the housing payment.
So like outside of this, Patrick, the interest rates is something to take into account as well. I mean, they've been still on historic lows, right?
You read my mind. That's exactly where we're going. So let's talk about make a real life example here from Q4 in 2019. So the end of 2019 to the end of 2020. So let's make some real life examples here, some real calculations. So we have seen 7% appreciation in prices. So we talked about, median sales prices versus average versus appreciation. So in general, we've seen a 7% appreciation rate. Okay. So average sales price, again, national averages, numbers are gonna be a little bit higher in the, Metro Boston area, but, the math is still the same. So fourth quarter, 2019, 327,100. If we saw a 7% appreciation, that exact same home in Q4 2020 would be 350,000. Okay. Now, here's where we start to get some interesting info. In fourth quarter 2019, average 3.75%. Now, of course, people's credit scores and the amount of their down payment and, the type of loan product that they're taking out are all going to have an impact on what the rate is. So, just a round number here. For most people, it was likely to get a rate of about 3.75 at the end of 2019. Okay. At the end of 2020, we're looking at 2.75. So a drop of 1%. Okay. So,
It's a ridiculously low number.
yeah, so let's assume in this example that we have a consumer that is going to finance 90%. So they're giving a 10% down payment. Okay. So the loan amount they'd be seeking in 2019, 294, 390. That's 90% of that 327, 100. Okay. In 2020, it's 315,000. So you're right. I mean, there is an increase of $20,600. So again, this is where the mass media is going to say, "Hey, homes are less less affordable. You have to finance $20,000 more. The price is increased by 20 more than $20,000. This is leading to an unaffordable, unsustainable market." Not correct, because they're not looking at the right metrics. So if we take a look at the monthly principal and interest payment, the P&I, in 2019, based on these numbers, you're looking at, and I'm rounding the nearest dollar here, $1,363 for principal and interest in 2019. So that exact same home that is now appreciated and is 7% higher, but because the interest rate is lower, even though you're financing more dollars, your monthly payment is lower.
By
Your monthly payment is lower by $77. So yes, price has gone up and you're borrowing more dollars, but the net result is your principal and interest is $77 lower. Math is hard, I know, but that looks to be more affordable. But let's be fair. Let's cover all the details, though. Okay. So if you're financing 90% of the value of the home, you also have to pay mortgage insurance, private mortgage insurance, PMI. Okay. So the way PMI is calculated is a factor of what was factored into it is the amount of the down payment. It's based on the loan amount, based on credit score, a few other factors. So on average in 2019, based on this transaction, you would expect to be paying about $113 in private mortgage insurance on top of your principal and interest. Okay. Now in 2020, because you're financing more dollars, the cost of PMI also goes up. So it goes up by $8 a month, give or take. Again, depends on what your credit score is and a few other factors, but round numbers, it's going up by $8. So the total payment here in 2019 would be $1,476. In 2020, it's $1,407. Net result is you're buying a home that in fourth quarter 2020 that is 7% more expensive than what it would have been the prior year, and the net result is your payment is going down by $69 a month. Again, I know math is hard, but that looks to be more affordable, not less affordable to me.
Phrase I use, Patrick, very often with my buyers, and actually also with when I'm selling a property too, is you live in the payment, not in the price.
Exactly.
It comes down to all those the combination of factors. It's that at the end of the day, what are you paying? How you can afford it or not depends on what you pay every month.
Right. And as the QVC, I think it was QVC star Billy Mays would say, but wait, there's more. Okay. So the down payment. So just to be fair, we got to cover all the bases here. So down payment, if you're putting 10% down in fourth quarter 2019, $32,710. In 2020, if the prices have increased to $350, 10% of that's $35,000. So yes, you're coming up with slightly more, almost $2,300 more out of pocket to make up that 10% down payment. So it is slightly more expensive to get to the closing table. Okay, and again, but wait, there's more. So the income needed to qualify. Okay, so as we took a look at those weekly earnings, we've seen that the increase has been 5.9%. So again, if you had that $5,000 a month in income in fourth quarter of 2019, if you actually saw that 5.9% increase in income, $5,295. So your income has gone up by $295 a month, and the payment has gone down by $69 a month. I still can't wrap my head around how the mass media is portraying that as being less affordable. You've got more income and a lower payment. Everything there screams to me that it's more affordable, not less affordable. So again, math is hard. So this is why we want to play out those numbers to make sure that the consumers out there can see that it actually is more affordable today than a year ago to purchase a home. So,
if I'm correct, by about $226 a month.
well, no, it's $69 a month in payment.
Yep.
Oh yeah, so once you factor, yeah, exactly. Once you factor in what the income is, yeah. So you're spending less on housing payment, and you're also earning more.
Yeah.
Again, that screams to me being more affordable. But again, to be fair, yes, it is going to cost almost $2,300 more to get to the closing table to be able to purchase that home today. Okay. And it seems like, the increase in price and the increase in down payment is what the mass media is sort of keying in on here, focusing in on for their basis of saying, hey, homes are less affordable today.
And of course, the increase in price I gets away a little bit from the affordability thing, but you're buying an investment, even if it's your own home.
Yep.
So there's going to be an increase in equity as price goes up as well.
Correct. So let me do this and see if I can stop the screen share and just put it back on the two of us. And I think that worked. Okay, great. Yeah, all the technical controls we're trying. So I'm not just a mortgage expert. I'm getting better at the video controls too. So we're working on it.
I do have a question for you.
Sure.
So we go through the stats, but there's another statistic that's out there, and I think it's probably fairly established that in the early 2000s it was about 70% home ownership, and now today, call it 2020, 21, it's gone down to less than 65%. How can you account for that? Is that an affordability thing, or is there something else at play?
No, I think it's really just lack of inventory. So we since the we'll call it the Great Recession, so the last housing bubble, housing collapse, started in 06, 07, 08. And since that, and sort of the constriction in mortgage financing, builders have been building less homes. Okay, so even then, not exactly keeping pace with population growth. Okay, so we've had a period of time of 7, 8, 10 years where new builds have not been keeping up with demand with population growth. So we talk about population growth, it's literally, as people get older and reach that sort of first-time home buyer demographic, as well as immigration into the country, there's just not as many homes being built to accommodate those people that want to buy those homes.
Is it also possible that might be a little psychological? You looked at back in 2008, like we call it the Great Recession, that people, particularly the younger generation, that it was a mortgage crisis that caused that.
Yep.
Would that be part of it too?
So yes and no. So while the mass media again is sort of spinning that story and saying that the younger millennial generation that maybe saw their parents go through that housing crisis, and maybe they lost their home, that that generation that lived through that as young kids don't want to face the same issues, that they don't want to own a home because they could end up losing it like their parents did. Okay, that's what the mass media is sort of portraying as part of the situation currently. But I beg to differ based on my experience working with people in that age bracket. They actually do want to own a home. Okay, they want more of the safety and stability. And here's the good news: all those financial products, all those mortgage financing products that we'll call them exotic loan options with interest only or negative amortization, that can easily get a consumer into trouble. And
liar loans.
Oh, exactly. Yeah, the stated income, the no doc, that got people into a situation where they actually borrowed a hell of a lot more than they really could afford. All those loan products are gone. You can't do that anymore. So
Or a
the
lot of those
younger
brokers.
generation, yeah, the younger generation that saw their parents get into trouble with some of those exotic loan products and end up losing the house. Well, the generation of buyers today, they can't do that. That loan product doesn't exist. So if so the underwriting criteria is more concrete, much more well-defined, as stable as it's ever been. So if you're qualified for mortgage financing today, yes, it is a rigorous process, okay? And I call it the great equalizer. So it doesn't matter what your whether you're a man or a woman, what your ethnic background or race is, doesn't, none of that stuff matters. Everybody has to fall into line in the same qualifying criteria. Okay, so those liar loans, the stated income, the exotic loan programs are gone. If you qualify for mortgage financing today, you're on as stable footing as anyone has ever been. Now, that doesn't necessarily mean that it's tougher to qualify for financing. It just means that the people that do get that mortgage financing, they are qualified. They're not dealing with these exotic loan products where the financing situation can get out of hand to a point where it becomes unaffordable, and you're going to get to the point of losing your
I'll
home.
correct you there. So
Yeah.
it is tougher for those that can't afford it, and therefore these loans are not.
Well, yeah. So the people that maybe in the past might have gone for those, those liar loans, the
Yeah.
stated incomes,
Not
those
available.
products don't exist anymore. So that you really have to prove that you can afford the home. And as long as you can prove that you can afford the home, well, then great. Those numbers we just showed you in terms of the affordability matrix, it's a great time. It's much more affordable today than it was a year ago, based on two contributing factors: lower interest rates as well as increase in weekly earnings.
Very good.
So hopefully we didn't bore the hell out of too many people here with all of the statistics. I know math is hard, but try to break it down in a simple, easy to understand manner. So please go back and rewind and take a look at those numbers, and double check me, make sure my math is correct. I think it is.
Feel free to reach out to Patrick if you have any other questions too on those numbers or.
Yeah, absolutely. So I'm here as a resource. Always put myself out there as a resource for my clients and their friends and associates and all of my connections on social media. I'm here as a resource for you. Please reach out. Have a home in mind. We want to run some specific numbers on to see exactly how it's affordable in your specific situation. That's what I do. That's what I'm here for. And if you are looking for that affordable home, if you are looking to purchase, whether it's your first home or you're trading up or buying investment property, my friend in the real estate business here, Declan O'Toole, I know would be happy to help you. And Declan, we do work together quite a bit. I'd like to say we're a pretty good team when it helps getting people to the closing table. I'm not gonna say who's Batman and who's Robin, but we've got your team here to help you get to the closing table. So reach out to Declan, reach out to me. We were both tagged on this video, so you'll be able to find us. So we're hitting just about a half hour here, so I think that's pretty much the length of most people's attention spans for some of these videos. So we should probably wrap it up at this point. I want to say thank you to Declan for joining us.
Thanks for having me, Patrick.
As the co-host here of the Wicked Awesome Report. I'm Patrick Quayle, your host of the Wicked Awesome Report. Thanks for tuning in. If you like what you saw and heard today, again, please reach out to Declan, reach out to me, give us a like, a comment, a share here on social media. And until the next time, hope everybody out there stays awesome. Take care.
Bye-bye.
Okay, so we'll end the broadcast.